Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today is November 28th, 2025, and we are diving deep into two really powerful economic forces that are shaping your wallet and, frankly, the entire global technological future.
They really are.
On one side, right here at home, we have the strained American consumer economy. We're all wrestling with a holiday season that just feels, well, historically expensive.
It does. And on the other side, we're looking overseas. We're looking at this high-stakes, government-driven push in China's high-tech robotics sector. It's a race for efficiency, a race for global dominance.
And our mission today is really to connect these two stories because they seem so different, but they're not.
That's absolutely right. We're going to start by unpacking the raw data from this year's Black Friday sales. I mean, we really need to look at how major trade policies, specifically these high tariffs that have been in place for years now,
Right.
how they're translating directly into some pretty painful sticker shock for you, the average shopper. And we'll get into the alarming trends in household debt that signal real stress.
Okay, and then after that,
And then we pivot. We're going to move to the high-speed, highly complex world of China's humanoid robot sector. We'll analyze these dramatic regulatory moves by their top economic planners.
this is that bubble cleanup I've been reading
It's
about.
exactly a bubble cleanup. And the result of this is the creation of massive, really structured investment opportunities, but only for those who understand which parts and which companies are now, state approved for explosive growth.
So we'll distill the biggest surprises from the analyzed data, and we'll offer clear, actionable insights on how you should view these trends. Whether you're just starting to learn about economics or you're actively building out your portfolio, understanding these dynamics, it gives you a massive advantage.
It really is.
So let's begin where most Americans are feeling the pinch right now. The holiday shopping season, Black Friday 2025. It just felt fundamentally different from other years. The buzz was way down, and the deals, well, frankly, they felt a little deceptive.
A little. I think that's being generous.
Fair enough. The core issue, according to a detailed analysis of all the transaction data, is this really painful realization of what we're calling tariff inflation.
Right. And this isn't the abstract inflation we talk about every month from the government reports.
Yeah.
This is specific. It's direct. This is where the actual cost of tariffs on imported goods has been fully passed down the chain.
From the importers, from the manufacturer.
Right onto you, the consumer. There's no buffer left.
So let's talk about that mechanism, because these tariffs, they've been around for a while.
They have. They were largely implemented under Section 301 of the Trade Act of 1974. And the original idea was, to create leverage to protect domestic industries. But in practice, they operate like a hidden sales tax on imported goods.
Mostly from China.
Primarily from China, yeah. Finished products, essential components used in manufacturing right here in the U.S. And for years, retailers tried to absorb some of that cost.
They did. Or they'd try to find other suppliers, right? Maybe in Vietnam or Mexico.
Exactly. But the supply chains were often more expensive to begin with. Yeah. And our analysis shows that strategy has just reached its limit. The cumulative pressure of these multi-year tariffs, plus domestic wage inflation, plus high operational costs, retailers simply can't afford to eat that cost anymore.
So they're passing it on, systematically.
They have to. The dam has broken.
So let's unpack this with some hard numbers, because they are pretty striking. I think the most compelling evidence here is the dramatic drop in average discount rates. This is based on real-time data from Adobe Analytics over the holiday weekend.
That's the smoking gun. If you look back at 2024, which already felt kind of expensive,
It did.
the average discount rate across all product categories was still respectable. It was hovering around 31%. Shoppers could find real deep discounts.
31%. Okay, that feels like a real sale. You feel like you're getting a deal.
Exactly, a real sale. But this year, the analyzed data shows that the 2025 average discount just fell off a cliff. It dropped all the way down to just 23%.
Wow, that's an 8 percentage point difference. That's huge.
It's massive. It translates to billions in lost savings for consumers. And it represents this fundamental shift in how retailers are trying to protect their margins. This reduction in the discount is their main way to secretly offset those increased import costs without, just jacking up the sticker price so high that nobody walks in the door.
But the net effect on your wallet is just as painful.
Even more so, maybe.
But wait a second, isn't that just standard inflation? I mean, why are we specifically blaming tariffs and not just, say, general wage growth or higher fuel costs? The official inflation rate has actually come down a bit from its peak.
That's an excellent point, and it highlights a really critical distinction. So general inflation, that impacts the cost of doing business. Your wages, your rent, your utilities.
Right.
But tariffs impact the specific cost of the underlying imported product. And the reason we can isolate the tariffs is because of what we're calling the price reversal phenomenon, which was all over social media this weekend.
Ah, I saw some of this. This is where it gets really frustrating.
It's incredibly frustrating for the shopper. Consumers are posting pictures, noting that when they saw a big 30% off sticker, the final price was still higher than last year's full retail price for the same item.
Sometimes significantly higher.
Oh, yeah. And people are asking, how does this happen? It's because the fundamental base price of the product, before any discount is even applied, has been cranked up so dramatically. The tariffs have inflated that starting line. They've set a new, much higher economic baseline.
Okay, let's run the numbers slowly on that so everyone can really visualize this hidden tax.
Absolutely. Think of it like a chain reaction. Last year, that nice 55-inch TV cost the retailer, say, $800 to import. They sold it for $1,000, full price.
Okay.
A 30% discount brought it down to $700. A clear win for you.
A great deal.
A great deal. This year, because of the cumulative cost of tariffs on the components, plus global shipping hikes, the cost to import that same TV is now $950. So the retailer has to list the MSRP at $1,250 just to maintain their margin.
Right.
Now, when the retailer applies that same 30% discount, it's a discount on a much bigger number. The sale price is now $875.
So you think you got a deal?
You did,
Yeah.
technically. But you're still paying $175 more than you paid for it on sale last year. You're paying almost $100 more than the TV's full price was last year.
The discount percentage becomes meaningless.
Functionally meaningless.
Yeah.
It's just masking a massive inflated base cost.
That is a critical insight. It explains why inflation can feel so stubborn, even when the official rates seem to be getting better. It's the accumulated cost of these policy decisions that just never really goes away. And the data shows specific sectors were hit hardest, which confirms its link to imports. It was consumer electronics, those TVs, laptops, and also, pretty significantly, apparel and footwear.
All things heavily reliant on Chinese manufacturing. And to use another analogy for anyone just trying to buy groceries, imagine your favorite imported coffee beans cost $10 a bag.
Okay.
Suddenly, because of import taxes, which are like tariffs, the base price becomes $15. The store then offers a 20% off sale. So you paid $12, you feel like you got a deal, but you're still paying $2 more than the original non-discounted price.
That $2 gap,
Yeah.
that's the tariff.
That's the tariff, fully absorbed by your wallet. It's just masking how much the real price floor has risen.
So how are Americans reacting to this? To a holiday season full of non-sales and these deceptive discounts, the data points to classic textbook signs of consumer stress. People aren't just annoyed, they're changing their behavior.
Fundamentally altering their consumption and borrowing habits.
Yeah. I mean, we saw the National Retail Federation, the NRF, dramatically lower its year-end sales growth forecast. They started out thinking, okay, maybe a decent 3.5% growth.
Which is already kind of modest.
Right. And now they've cut that down to a much more sluggish 2.5%. And that slowing consumption is driven by this financial squeeze.
Yeah.
This painful double whammy of high inflation and high interest rates.
Which makes borrowing money, whether it's on a credit card or some other loan, just agonizingly expensive.
And this brings us to what might be the most concerning behavioral shift we're seeing in the analysis. The record rise of buy now, pay later services, BNPL.
Yes. For anyone who isn't familiar, these are services like Affirm, Klarna, or the options PayPal offers. They let you instantly break up a purchase into several installment payments.
And they seem great on the surface, often interest-free if you pay on time.
If you pay on time. But they come with hefty fees or steep interest if you miss a payment or you're delayed.
It's basically a very accessible form of credit. It kind of bypasses the traditional credit card process. And the surge it's just undeniable.
Payment volumes through these services are up an astounding 18% year over year. They hit an all-time high this Black Friday weekend. And this isn't just a sign of convenience or people liking digital payments.
No.
The magnitude of this surge points to a deeper financial necessity.
So our interpretation of this is critical for understanding the health of the American household. This is a clear sign of, what did you call it, recession-style consumption.
Exactly. Or consumption that's operating right at the very limit of the household budget. Consumers are actively pulling future income forward. They're using next month's paycheck to pay for this month's gifts.
Simply because they lack the cash flow now?
Precisely. They can't cover even moderate holiday purchases outright. So we have to view this BNPL surge not as some great e-commerce innovation, but as a flashing red warning light about the underlying strength of household finances.
The analogy for this one seems pretty concerning.
It is. It's like taking out an increasingly expensive short-term loan just to afford what used to be routine holiday gifts. When people are using multiple installment plans for things that used to be covered by cash flow, a new coat, a small electronic gift, even groceries, it just highlights a severely strained budget,
It implies the financial foundation is weakening.
which inevitably leads to consequences down the road. Debt piles up and delinquencies start to rise.
So for investors, this environment, high tariffs, high prices, consumers who are stretched thin, it demands a really surgical approach. You can't just bet on all retail doing well.
No, the rising tide is not lifting all ships, not anymore. We have to identify who loses market share and who actually gains it when consumers are this sensitive to every single penny.
And we're seeing a really stark corporate divide emerge, a bifurcation of retail.
We are. Retailers that are heavily reliant on large volumes of imported goods, think about department stores, mid-tier apparel companies, big box electronic stores, they're suffering. They're in a no-win situation.
Because they either have to absorb the tariff costs and just crush their already thin margins,
Or they pass the full cost to consumers and risk losing all their sales to competitors who have better scale.
but not everyone is losing. The data strongly emphasizes this power of scale and negotiation. The definitive winners in this high-cost, low-growth world are the companies with massive purchasing power and really efficient supply chains.
Which leads directly to our first key investment focus, the essential consumer goods champions. In this kind of defensive environment, investors should really be focusing their attention on market leaders like Walmart and Costco.
They're not immune to inflation, obviously.
Not at all. But their sheer size gives them unparalleled negotiating leverage with their suppliers. They can demand lower costs, which allows them to offer the lowest possible prices, even with these inflationary pressures.
And crucially, these companies often expand their market share during economic downturns.
Precisely. Because consumers naturally trade down. They move away from higher-priced or specialty stores and go searching for that guaranteed value they find at the giants. These are the safe havens in a really distressed retail landscape.
And on the other side of that coin, investors need to heed the warning about the middle ground.
Absolutely. The analysis is clear. Be extremely wary of mid-tier retailers, department stores, and those, ambiguous apparel brands that lack strong pricing power.
They're caught in the squeeze.
Totally. They lack the supply chain leverage of the giants, but they also don't have the brand prestige of high-end luxury. So they lose customers to Walmart on price, and they lose customers to LVMH on status. In a high-tariff world, they are just structurally disadvantaged.
Okay, moving beyond just the retail sales figures, that BNPL surge requires really close monitoring. The ripple effects hit the financial sector and the whole trajectory of the U.S. economy.
We have to elaborate on what we're calling the BNPL time bomb. I mean, yes, the immediate spike in transactions is fantastic for the BNPL companies themselves. A firm is generating fees on a record number of purchases.
So their stock might look good in the short term.
It might, but it carries a significant long-term risk for the entire financial system. And that risk is the specter of household debt default and rapidly rising delinquency rates in the midterm. It's deferred pain that's going to roll into the first and second quarters of next year.
And if consumers are using these loans for holiday shopping because they can't afford the inflated prices, what happens in January and February, when rent is due or big insurance bills hit?
Exactly. And that leads to our focus on monitoring credit risk. Investors have to closely monitor the financial institutions exposed to this.
So obviously the BNPL firms themselves and fintechs like PayPal.
Yes, but also the traditional credit card issuers. Think Capital One, Discover. And we have to pay extreme attention to two specific metrics in their quarterly earnings reports. First, trends in their delinquency rates. How many people are missing payments?
A rising delinquency rate is the first sign of trouble.
The canary in the coal mine. And second, and maybe more importantly for the health of the banks, is their setup of loan loss reserves.
Explain what that is.
Think of a loan loss reserve as a bank's rainy day fund. It's money set aside specifically to cover loans they expect customers won't be able to pay back.
So if BNPL usage suggests widespread financial strain,
Banks have to increase those reserves. dramatically. And if you see those reserves start ballooning quarter after quarter, it's a major red flag for the whole consumer credit system. It means the banks themselves are anticipating a wave of defaults. That signals deep, deep trouble in household budgets.
And finally, let's bring this back to the macro picture. Inflation and the Fed. This Black Friday, where discounts couldn't even get prices back down to last year's levels, it shows that inflation is stubborn. It's systemic.
And it's far from over, specifically because of these sticky trade policies. And that's the critical takeaway for your broader strategy. This persistent inflation pressure, especially on goods sensitive to tariffs, makes it highly unlikely that the Federal Reserve will feel confident enough to lower interest rates anytime soon.
They have to keep policy restrictive.
They have to cool demand. And high rates are a massive drag on all stock valuations. For beginner investors, it's because high rates increase the cost of borrowing for companies. And more technically, they dramatically reduce the present value of future earnings.
Right. So a company might promise huge profits 10 years from now.
But when the current interest rate is high, that future cash flow is worth a lot less today. It's a mathematical reality that just suppresses valuations across the board.
So the defensive position holds.
It holds firm. With stubborn inflation and high rates, having a stable strategic cash position is wise. It lets you deploy capital when opportunities arise. And considering tangible inflation hedges like gold or other real assets is still a necessary strategy.
So to summarize this first section, this depressed Black Friday is really a symbol of how current trade policy, the tariffs and sticky inflation have just severely constrained consumption.
And that situation demands a highly defensive investment strategy. It has to be focused ruthlessly on companies providing essentials and safety and moving decisively away from those high-risk, discretionary retail plays.
Okay, we are now executing a pretty profound shift in focus. We are leaving the strained wallets of the U.S. consumer and shifting to a place of government-mandated, turbocharged growth. China's incredibly ambitious push into the humanoid robotics industry.
It's a huge shift, but it's a necessary one.
It's an industry marked by incredible speed, massive state capital, but also this intense regulatory intervention that's designed to win the global race.
And this transition is actually much smoother than it appears. The U.S. consumers' demand for cheaper goods, which tariffs have made so difficult to fulfill, that just reinforces the global push for maximum manufacturing efficiency.
And that efficiency in the next decade will be driven by automation, specifically humanoid robots.
That's the end game. The context here is crucial. The Chinese government has explicitly identified humanoid robots as a key future industry. It's essential for them to maintain technological leadership, especially with the ongoing trade tensions.
But the industry grew too fast, right? Chaotically.
Exactly. The early phase was plagued by overlapping, inefficient investments. Way too many startups producing similar, often low-quality products. It was the classic high-tech bubble pattern just fueled by easy capital.
So it seems like the government's patience has run out, and now we have a major regulatory action designed not just to slow things down, but to bring strategic order to all that chaos.
That's the perfect way to put it. We need to detail the significance of the National Development and Reform Commission's action, the NDRC.
They're basically China's top economic planning agency, the economic traffic cop.
The traffic cop, exactly. And on November 25th, they announced the High-Quality Development Guidelines. And this document is far more than a suggestion. It's a strategic roadmap, and it's backed by the full force of state funding and preferential policy.
So what's the core message here? What are they telling the hundreds of startups all vying for attention?
The core message is unambiguous: trimming the fat. This document is being universally interpreted as the practical way to remove the bubble, to get rid of the inefficient, the redundant, the purely speculative companies.
They want concentration. They want focus.
And globally competitive quality, not sprawl. They believe they can't win the global race with 1,000 small, weak companies. They need 3 or 4 giants. And crucially, they've set up new, rigid, selective support criteria.
Okay, so this is how they pick the winners.
This is how they pick the winners. Government aid, subsidized financing, key contracts. It's all now going to be prioritized based on 2 clear, measurable metrics. First, the localization rate of core components.
Things like, what? The gears and sensors?
Exactly. High-tolerance precision reducers, advanced sensors, high-performance batteries. They are demanding domestic self-sufficiency to eliminate any supply chain vulnerabilities.
And the second criteria is focus on the brains of the operation, the software side.
Yes. The second is the measurable performance of the AI brain, what they call embodied AI. This refers to the robot's ability to understand the physical world, plan complex actions, and navigate or manipulate objects on its own in messy, unstructured environments.
So not just repeating the same movement on a factory line over and over.
Not at all. And if a startup can't demonstrate excellence in either hitting those localization goals or having a cutting-edge embodied AI platform, their funding is now very likely drying up immediately.
This is so key for investors. When the state explicitly dictates the criteria for success and failure, it creates a much clearer roadmap for where capital should flow.
It removes a lot of the typical market uncertainty and replaces it with policy certainty. A ruthless roadmap, but a clear one.
So what are the immediate effects of this government signal on the ground in China? The first battleground, it seems, is price.
It always is. It's a classic move in China's industrial policy playbook to eliminate the weak fast. The price war is now fully engaged.
And who are the major players?
You've got firms like UBTech, a market leader, Xiaomi, and Unitree. They are all aggressively releasing entry-level humanoid robots priced under 100,000 RMB.
Which is, what, about 14,000 US dollars?
Roughly 13,900 US dollars. Yeah.
Under 14 grand for a fully functioning humanoid robot body. I mean, that speaks to an extraordinary level of manufacturing efficiency already.
It is staggering. It's driven by their existing EV and component supply chains. But the implication of this rapid price compression is that it acts as a huge, deliberate pressure cooker. It's driving smaller, less advanced competitors right out of the market.
They just can't match that cost.
Not while maintaining the quality you need to get government approval in Tier 1 contracts. It's industrial Darwinism, mandated by the market leaders who are, tacitly supported by the government's push for consolidation.
Okay, let's address the global benchmark here. Tesla's Optimus. The analysis I've seen suggests there's a hardware parity, but a software lag. Can you elaborate on that technology gap in the AI?
It's an interesting split. The data suggests Chinese companies have largely achieved hardware parity with, and sometimes even exceeded, the physical specs of Tesla's Optimus model. When you look just at the motors, the actuators, the joint flexibility, the guts of the robot, they are highly competitive.
Because of their decades of dominance in general manufacturing supply chains.
Right. But they still lag significantly in the software AI brain component, specifically that embodied AI, the ability for the robot to learn complex, non-repeated tasks on its own and then generalize that knowledge to different environments. That's where U.S. firms still hold the lead.
Driven by companies like NVIDIA and the big language model breakthroughs.
Exactly.
So the body is excellent and cheap, but the high-level intelligence isn't quite there yet for generalized tasks. What's the strategic response from the Chinese firms to close that crucial AI gap?
Well, they know they can't build the software from scratch as fast as the U.S. giants, so they're actively seeking collaborations with their own major domestic tech companies, Alibaba, Baidu, who have the cloud computing power and vast AI training datasets.
The strategy is to integrate the best domestic AI into the best domestic hardware.
Simple as that. They know that for their hardware to compete globally, they need top-tier domestic software to run it. And from an investor perspective, despite all the warnings about bubbles, the stock market has actually reacted quite positively to the established leaders.
So UBTech, Top Band, Sanwa, their stocks are doing well.
Robust performance. Investors are reading this NDRC action not as a risk to the industry, but as a proactive move by the state to clear out the inefficient competitors, specifically to favor the top players. The government is setting the stage for a winner-take-all outcome.
And that's highly profitable for the winner.
For the chosen winners, yes.
So given this intense volatility, this government-managed restructuring, the key question for our listeners is, where is the safest, most guaranteed return in this explosive but really volatile sector?
You have to follow the policy direction, not just the market hype. And the data points strongly towards avoiding what we call the red ocean of finished products.
Meaning, don't just bet on the final robot.
Exactly. Betting on a single final robot manufacturer, the body, is inherently risky because of that brutal price war. You just don't know who will survive the final round of consolidation.
So the core investment insight is to prioritize the components.
Prioritize the core components. The safest, most structurally protected investment is in the companies that manufacture the essential, complex, highly technical parts that every humanoid robot needs, regardless of who wins the final race. These are the mandatory parts, the fundamental anatomy that the government is demanding be localized.
So what specific targets are we looking at? Which components are getting this intense policy focus?
The primary focus areas are extremely technical. First, precision reducers, especially those based on harmonic drive technology. These are the joint control mechanisms. They are the most critical, high-margin part of the robot's motion control system.
And what else?
Second, ball screws, which convert rotational motion into linear, pushing or pulling forces. Third, high-performance sensors, especially the force and tactile sensors needed for the robot to feel its environment. And finally, integrated robotic joint modules, which combine all these parts into one efficient package.
Okay, let's spend a moment on those precision reducers, the harmonic drive tech. Why are those so difficult to make, and why does that make the companies that master them such a safe investment?
That's where the scarcity is and where the high margins are. Precision reducers are the crown jewel of robot motion control. They're specialized gearboxes that provide extreme torque while maintaining microscopic levels of accuracy and zero backlash.
Meaning no slack in the joint when it changes direction.
No slack at all. They're incredibly difficult to manufacture. They require exceptionally high-tolerance machining, specialized metallurgy, and decades of proprietary know-how that's traditionally been held by companies in Japan and Germany.
So if a Chinese firm masters this,
Which is what the NDRC is heavily subsidizing them to do. They eliminate the supply chain risk for every single Chinese robot body manufacturer. A company that makes high-quality reducers benefits from the success of UBTech, Xiaomi, and Unitree,
they've diversified their risk across the entire market.
making them a structurally protected investment. The logic is simple. If China is going to be the world's largest supplier of humanoid robot bodies, it cannot rely on foreign companies for these essential high-margin parts. So these component makers get huge internal policy support and have high potential to export their parts globally.
Even to firms like Tesla.
If the quality and price are right, absolutely. It's a dual market opportunity with inherent government insurance.
Okay, that makes a powerful case for the parts manufacturers. But if we are going to invest in the robot body itself, the final product, how do we pick the winners in this impending shakeout?
This is where understanding the value of government structuring is crucial. In a free market, consolidation is chaotic. In China's model, consolidation isn't a threat to the market. It is a necessary, mandated step toward maturity. The government ensures a streamlined winner-take-all environment.
So the investment insight is just to focus on the top tier.
Tier 1 focus, exactly. Concentrate your investment on the top 1 to 3 robot body manufacturers that are most likely to get sustained government support, the best financing, the biggest pilot contracts. These are the firms the state has decided must survive,
And when their weaker competitors disappear, their market share grows exponentially.
leading to explosive stock gains based on future volume.
Let's revisit that value chain split. We said U.S. firms lead the AI brain, China leads the cost-effective body. How should investors use that knowledge when they're evaluating these Chinese companies? What metric matters most?
When you're evaluating these Tier 1 Chinese robot firms, you should intentionally downplay the significance of cutting-edge AI algorithms for now. Instead, you should focus ruthlessly on manufacturing efficiency and mass production capability as the absolute key performance indicators.
Because China is positioning itself to be the world's hardware factory for humanoids.
Just like it did for smartphones and electric vehicles. The real profit for these firms will come from achieving massive scale and relentless cost reduction, making a serviceable, affordable robot for industrial use, not necessarily from developing the most sophisticated human-like software just yet.
So we're looking for the next Foxconn, the next BYD, but in the robotics space. We should be looking at factory throughput, supply chain integration, cost projections.
Precisely. The traditional hallmarks of successful Chinese manufacturing giants. And finally, we have to emphasize the critical need for policy monitoring. The NDRC's recent bubble cleanup is just the beginning. Investors have to diligently watch future policy announcements, especially the upcoming 15th Five-Year Plan. This plan will detail exactly which specific technologies, advanced sensors, lightweight materials, specialized power systems will get concentrated government subsidies and tax breaks.
And identifying those subsidized technologies allows you to preemptively select the companies that are about to get a guaranteed financial boost.
It gives you a significant market advantage derived directly from state policy.
So to sum up Section 2, the Chinese robot market is shifting from chaotic expansion to structured, state-directed growth. And the focus for long-term investors should not be on the hype, but strictly on the core parts the state demands be localized, and on the few Tier 1 manufacturing giants who are guaranteed to benefit from this cleanup.
The bubble isn't popping. It's being professionally refined for dominance.
That was a tremendous amount of crucial information to process today, covering two diametrically opposed economic landscapes, the constrained U.S. consumer and the turbocharged Chinese robotics industry.
A lot to unpack.
We started by covering how tariff inflation made Black Friday discounts deceptive, pushing American consumers toward dangerous levels of debt through BNPL services.
And then we analyzed that strategic, government-led shift in China's robotics sector, where regulatory intervention isn't hindering growth. It's actually creating very clear winners and losers by forcing an industry shakeout and demanding localization.
And in both of these seemingly different stories, U.S. retail and China robotics, the message for the investor is strikingly similar.
It really is.
The era of easy gains, where you could just buy the sector index and expect broad success, is fundamentally over.
That's the final thought for you, the listener. In both the retail and robotics markets, we are now in a phase that requires rigorous selective focus. You have to concentrate on essential, high-quality companies with proven pricing power or dominant structural advantages.
Whether that's the supply chain scale of a Walmart in a defensive consumer market,
Or the core technology dominance of a precision component manufacturer and a state-backed high-tech race. Quality and essentiality are the only things that will protect and grow your portfolio now.
absolutely. And think about this as you move into the new year. Consider how the Federal Reserve's necessary stance on tackling this persistent inflation, which is fueled in part by these tariffs, how that impacts not just your mortgage rate, but the pricing power of every single company whose products you buy.
That connection is everything.
That tangible connection, from federal policy right down to your personal purchase, that's where the real insight and investment advantage lie. Don't forget to subscribe and hit that like button.